My name is Dennis Kelleher, and the derivatives panel is called "Why do we need a $700 trillion market?" We should remember that the last crisis was invisibly incubated, grew massive risks, acted as a conveyor belt spreading those risks throughout the world, and ignited the crisis. And today we have EMIR at various points in the process. We have Title VII in the U.S. at various points in the process. Is the job done? And what's the job to do? And more fundamentally, does the derivatives market serve a real public purpose? Is it a gambling casino? And how much of each, if it's one or the other? It's interesting. The question is, do we need a $700 trillion market? It makes me ask, who's we? Is we the lobbyists who are enriching themselves by maintaining dark markets? Is the we bankers making billions in bonuses? Is the we industry who are hedging risks, real or perceived, as part of managing the real economy, so-called? Is the industry being ripped off by opaque derivatives? Is the we taxpayers of the world who are still paying the price for the worst financial crash since 1929 and the worst economy since the Great Depression? Better Markets did a study that shows that it's going to cost the U.S. no less than $12.8 trillion over 10 years. And there are other studies out that show $16 trillion over the 10-year window. Is that the we who needs a derivatives market? So when we ask this question and we focus on this market, there's a lot of issues and questions, including need. And as somebody once said to me, well, what I need is the created complexity of derivatives because it enables me to conceal risk and embed invisible excess profits. That was not somebody in the real economy. So in any event, we have a terrific panel today. There are many questions to answer, and we're going to very quickly do some openings, have a lively discussion, and involve you at the end. And we're just going to work from my right on down. And to my immediate right is John Parsons, who's a senior lecturer at the Sloan School of Management at MIT, and all the bios are in the brochure. But John, in addition to being a professor, is an active participant in the debate and in the markets and has a unique perspective on many of these issues. And John, if you want to talk a little bit about that.
Great. Thanks very much. I'm delighted to be here and appreciate the chance to participate in this discussion. So I think on the derivatives market, when I've looked at the conversation over the last 5 years, the basic way I'd characterize the conversation is a big fear of the future. The idea that we would ever reform this thing and make things operate differently is just a very, very difficult idea for people to get their heads around. When we talk about the number of $700 trillion in derivatives and whether we need that much, many of the people in the industry oftentimes complain about these various regulations, the various requirements for collateral, the various requirements for clearing, as endangering a lot of the trading, and we're likely to see much less trading, as if somehow the amount of trading that we had to begin with was the right amount. Some people, especially those familiar with, in the industry, familiar with trading the way it has been done, just really cannot imagine it being done a different way. And almost all of the arguments against the reform largely come down to it's going to make the world different, and for heaven's sakes, that's a terrible thing. And I just don't have any sympathy with that kind of fear. Personally, I'm all in favor of a very active derivatives market. I'm all in favor of derivatives being used for the purposes to which they're intended. They can be, if used properly, a very fantastic instrument for managing risk. And if we regulate the derivatives market so that it's a well-run, efficient, well-managed system, it can be very useful to society. The question in my mind is not somehow the right amount of derivatives. The question is whether we manage it the right way. If we regulate it, if we manage it so that it's being run carefully and in a sensible fashion, then the trade that we'll get out of it is going to support the economy very broadly. So I would say we really have to get our heads out of only thinking about the world the way it most recently was, and have some courage to go forward with a new derivatives market, with one that's structured and in a sensible fashion, one that's structured so that companies are really appreciating the risk involved in various derivatives, so that the right amounts of security are involved, so that we have transparency and supervision the way we should. One thing I'd like to call attention to in this comment I'm making about this fear of going forward in the future is in the United States, we've been through this debate once before. It was a long, long time ago. It's kind of a history lesson. We have derivatives markets in the United States going back to the 1800s. They were primarily commodity derivatives, futures markets for grains, futures markets for metals and the like. And the original futures markets for grains in the United States operated the same way the OTC swaps market operated. There was no requirement for clearing. There was no requirement for margin. That was all up to the decisions of the individual traders. Starting around the turn of the century, we had this innovation of central counterparty clearing, the innovation that the G20 is trying to now bring back once again to the derivatives market. It was an innovation that made the derivatives market function better, but there was a lot of opposition to central counterparty clearing and to the mandate to use margins. In particular, the biggest derivatives markets in the United States, the Chicago Board of Trade, fought against that mandate for a long, long time until in the 1920s they finally gave in and became the last major derivatives market in the United States to operate with central clearing. One of the largest derivatives markets now in the United States, the CME, sort of the giant in the futures market, was founded in the early 1900s, 1919, with central counterparty clearing and mandatory margins as a part of their operating principles from the get-go. So from 1920, derivatives markets in the United States through 1970s operated with all of the features that the G20 is now trying to reimpose on the derivatives market. And I would say most of the 20th century, the derivatives market were a great tool for helping improve the real economy in the United States. Nobody complained about central counterparty clearing. Nobody claimed about margins somehow impeding the real economy. It was only in the late 20th century when we had this loophole of swaps, and we sort of let swaps be done differently, and then gradually they grew to be the dominant characteristic in the market, that we undermined the characteristic functioning of the derivatives market in the United States as it had been up until that date. Now, after the crisis, we have to look around and say, how do we really want the derivatives market regulated? Surprisingly, it wasn't actually a very hard subject to get a consensus around. If you look in the financial reform on a lot of other subjects, we can't get much consensus. We don't know how to regulate money market mutual funds. There's 25 different proposals. On bank capital, there are lots of different views about how bank capital should be done, what activities they should be able to do. But on derivatives, we had a very simple consensus in the Pittsburgh G20 decision. And one of the reasons we had that simple consensus is because we've been there before. We know how it works. It works fine. There's nothing to be afraid of.
Thanks, John. And it's amazing that the American academic would talk about history, because history in the United States is usually about 24 hours or so, and then we move on. So thank you very much. Next, we have Jennifer Robertson, who's the Deputy Head of Unit of the Financial Market Infrastructure at the EC, and her bio is in the brochure also.
Yes. Thank you very much. I would like to begin by looking at your first question, which was what were the objectives of the reforms that happened in the last 5 years and happened in Europe. I'll focus my attention on the EMIR reforms because we are the European Commission, we're not the CFTC or the SEC, so I won't comment on any of their proposals. So what were the reforms designed to do? Well, first of all, there were three main issues highlighted by the financial crisis. First of all, insufficient management of operational risk. There was also an insufficient management of counterparty risk, which materialized through a lack of collateralization on the market. And last of all, but not least, there was a lack of transparency, which meant that many of these problems remained out of sight of regulators. And I think that is the big idea post-reform, is that not just are we trying to make the market safer and more resilient, but we're trying to get an idea of what's out there and to make sure that regulators have a clear picture of what's going on. So how did regulators deal with these problems? Well, as the previous speaker mentioned, there were lots of global discussions. We had to sit down and decide what type of derivatives market do we want. And there were various conferences at the international level. There was the London G20, the Pittsburgh G20, and so on. And there was a lot of action also at the European level. But this boiled down to two main goals. First of all, we want to make derivatives markets safer. And secondly, we want to make sure they're more efficient. More efficient, why? Because if they're more efficient and they're working properly, then they should logically also be safer. So how did we do this? Well, first of all, to make markets safer and more resilient, we introduced the obligation for centralized clearing, which was mentioned by the previous speaker. It's a very powerful tool to manage and reduce the risks and volumes for outstanding contracts and ensuring the coverage of counterparty risk. These benefits were recognised in the 2009 Pittsburgh Summit, which introduced the obligation for all standardised OTC derivative contracts to be traded on exchanges or electronic trading platforms where appropriate and cleared through CCPs by the end of 2012. And this clearing obligation is implemented in Article 4 of EMIR. Secondly, because not all contracts will necessarily be eligible for centralised clearing because of insufficient liquidity or pricing information for CCPs, these contracts will not be cleared and they will have to be managed bilaterally. Therefore, they still have the risks, and those risks need to be managed. To mitigate all these risks, EMIR introduced requirements for financials and non-financials above a certain threshold to measure, monitor, mitigate the risks through operational processes such as electronic confirmations and so on. And there are also requirements for non-centrally cleared trades to make sure that they are appropriately collateralized through the posting of margins. And we'll maybe come back to that point later. The second objective of making markets more efficient is also done in a variety of ways. First of all, it requires more pricing transparency. This is one of the main objectives of actually MiFID II, which will impose an obligation to trade OTC derivatives on organised trading venues, and that was again another G20 commitment. Secondly, more efficient supervision of the markets is necessary, and this is one of the key points. This will be delivered through trade repositories, which give regulators detailed information on the markets. The first step is to collect that information and make sure it is available to regulators. And EMIR provides that all firms and all contracts should be reported, both trades cleared by CCPs and those that take place bilaterally. But probably even more importantly, regulators have to learn to manage all this information. So first of all, EMIR gives regulators the access to that information in trade repositories, but supervisors will have to learn to manage this information and to develop models to identify the forthcoming risks and to sort of develop some early warning indicators. So this is also going to be a learning curve for supervisors. Last but not least, efficient markets need a consistent and efficient international framework. Derivatives markets are global. 63% of interest rate swap transactions and 65% of FX derivative transactions were conducted cross-border in 2010. We have international principles set by global bodies like the Basel Committee, the CPS and IOSCO and so on. But in the EU, we have recognised this through so-called third country regimes. And these provisions grant the Commission the power to adopt decisions on the equivalence of the legal, supervisory and enforcement framework in third countries. If equivalence is granted, it provides deference to the rules of foreign jurisdictions with regards to CCPs, trade repositories, reporting, clearing, margin, risk mitigation techniques. And this is a very important element in our process. It's important to make sure that there aren't gaps in the international regulatory framework appearing, that there isn't creating scope for regulatory arbitrage, and that there aren't duplicative requirements which maybe impose unnecessary burdens on firms. And if we as international regulators fail to deliver such consistency, this is we risk missing the objectives of this massive reform that we've undertaken of derivatives markets. Maybe, do you want me to say a few words already on the size of the markets? Coming around to the second question. I mean, on the size of the markets themselves, there are we call them optimists and pessimists, I would say. And I could provide you with some interesting quotes. Maybe just one little aside is maybe you've had derivatives markets in the United States since the 18th century, but I was provided a quote by one of our staff which showed that they have existed in Europe since the ancient Greeks. So they've really been around a very long time here.
Take
but
that.
But as regards the size of the derivatives markets, I mean, we all know they have increased massively in the last 15 years. This growth has been concentrated on the OTC markets, which have multiplied by 10 times their size between 1998 and 2008. Nevertheless, there has been a decline in the size of the market since the crisis. By 10% for OTC derivative markets and 30% for listed derivatives markets. But one of the most striking features is the relative role played by derivative markets in the global financial system and the global economy. If you take a simple ratio that compares the volume of derivative markets to global GDP, derivatives markets were 3 times global GDP in 1998, 13 times that in 2008, and even in 2012, nearly 10 times global GDP. And although this is a very rough indicator, I think it clearly shows that the global economy relies more heavily on derivatives markets than in the past. So, I mean, the thing is, global derivatives have 2 main functions. First of all, they can be used to transfer risk between the economic agents, but they can also provide a role in investment and portfolio diversification. They do not create additional value as such or abolish risk, but they redistribute it amongst the market participants. And at least in theory, if markets are operating efficiently, these risks should allow the risks to go to those agents who can best manage them. So how should we do that? I think that for us, the most important point is that despite the risk management investment functions that markets can perform, the underlying problems that I mentioned, operational risk, counterparty risk, lack of transparency, can make these markets suboptimal and can pose real risks for the global economy at large. And that is what our regulatory reforms were designed to address. How are we doing it in them? So the question leads us to, well, how safe are and how efficient are the markets now with the reforms? Well, many of these reforms are still underway. I mean, if you take, for example, centralized clearing in the European Union, the process is underway. We have CCPs applying for authorization and recognition, and ESMA is now busy with this process. But this is a prerequisite for the advent of mandatory clearing by EU firms, because we need to ensure that those CCPs are adequately prepared and as safe as possible before we start sending all those contracts in their direction. Once this has been done, ESMA will then determine which classes of derivatives should be subject to clearing and when. And therefore, it's probably mid-next year before the clearing will actually start to kick in. In other areas, EMIR is already enforced. The enhanced risk management requirements that I mentioned are already in place. Other work, such as on margining requirements, are still underway, as are many of the provisions which were, I mentioned, in relation to MiFID, which are still subject to negotiations between the Parliament and Council. I'm very conscious of time. So, I mean, there's a lot of work ongoing and underway, and I can say a few words on that in response to any questions that you might have. But in essence, we have to be continually vigilant in the implementation of the derivatives markets reforms. We need to make sure that the reforms adopted both internationally and at the EU level are fully implemented in the way that they are intended. And we need to ensure that efforts to achieve safe and efficient derivatives markets are maintained. But more than that, we have learned from the 2008 financial crisis that market infrastructure is a critical component of the financial system, and it has to be stable in times of market turbulence. With this in mind, we are putting an awful lot of risk into CCPs. We are making sure that those CCPs are up to the test through high prudential and risk management requirements. Nevertheless, we need to ensure that there are recovery and resolution principles for CCPs in the near future. That is why that is one of the areas which the Commission has announced that it will intend to come forward with proposals next year. Just to conclude, we've done the first important steps to rebuilding the market, and we look forward to the growth that will come from this confidence, but we cannot sit back. We need to see these reforms through. We need to make sure the objectives are achieved. We need to make sure any loopholes are closed and that scope for regulatory arbitrage is limited. And I'll leave it at that. Thanks.
Thanks, Jennifer. Next, we're particularly lucky to have Richard Rayburn here. Richard is the chairman of the Association of Corporate Treasurers, and unlike everybody else, his bio is not in the program because as recently as Monday, he had thought he was doing something else today. But he has very kindly been drafted to fill in for George, who couldn't make it, and we're particularly grateful. But when the program is put on the website, you'll get his full bio on the website. But Richard has got vast experience and an important perspective that I know I'm particularly interested in hearing. And Richard, let us know what your thoughts are.
Okay, well, good morning. I guess I'm the mystery man then on this one. Just correct one thing. I chair the European Association of Corporate Treasurers. I only make that point to stress that I have a European view, I hope, not a UK view, which is the Association of Corporate Treasurers. I can't resist having a slight dig at Finance Watch, because the gentleman I've replaced was a very senior guy from ISDA, as I understand it. And I think that he was on the platform, and I'm on the platform, to try to represent the real economy, and I'm not going to make any apologies for referring to the real economy on a number of occasions, or the real economy or the end user perspective. And I thought that was really ironic that ISDA should be there to represent the real economy. ISDA is a trade body, and it's really symptomatic of a lot of what I've spent a lot of shoe leather in discussing and debating over the last 4 years. I don't think that financial trade associations, and equally I don't think politicians, academics or consultants are the best people to tell us how the real economy operates and how it responds to markets and what it needs from markets. So there is a wider issue here that legislators, in my view, need to be reminded frequently, and I make no apologies sitting next to Jennifer for doing that financial regulation has a real economy impact. And it's a recurrent theme in the dossiers that I've been spending time on, whether it's the derivative dossier, the financial transaction tax dossier, or now the money market funds dossier. Now, derivatives, weapons of mass destruction, as Warren Buffett said. I have to say, if I read another blog that quotes that, I think I should run screaming from the room. It's demonization of derivatives. I hope you'll come to see why I think there are some derivatives that are actually a very good thing and should not be demonized. But also, the second biggest cliche is to go back and refer to how long derivatives have been in use. And I'm going to trump John and Jennifer now, because John referred to Chicago, I think, in the 18th, 19th century. Jennifer went back to the ancient Greeks. I actually did a very quick bit of research in my hotel this morning, and I confirmed that at the very least the Sumerians, 3,500 years BC, were using instruments that we would recognize as derivatives. And by the way, there was no central clearing, and there was no cash collateralization of those transactions, and the world did not collapse around the traders who use those derivatives. And when I say traders, I mean real economy traders, not bank traders. So I think we need to have a more considered debate rather than a demonization debate. And in that debate, we need to be very sensitive to some of the nuances, some of the cliches that float around. One of those, which I've really come across at least twice this morning, is that the real economy speculates with derivatives. The real economy doesn't speculate with derivatives. It uses derivatives to eliminate risk. There are a few rogue traders. They get found out and they get fired, and their companies have to go to their shareholders and ask for more money. But that is not the general model. The general model is that derivatives serve a crucial purpose, which is to mitigate risk. And so I think I hope the debate, when I've finished, will at least pick up on that, if not on a number of other issues. I'm going to try and be serious and give a high-level answer to the question about the 700 trillion. The high-level answer is I have no idea. I don't know whether we need a market of 700 trillion. What I do know is that roughly 5% of the outstanding derivatives are actually end-user, non-financial counterparty transactions. And now, if we did not have those transactions, or if companies felt they couldn't enter into them because of the conditions in which they can use derivatives, then you would have much more volatility in the real economy. You would have setbacks to employment and to growth. And I think that all of us in this room, whether we're European or outside, coming from outside Europe, have a commitment to regulatory and political objectives that are based on stimulating and sustaining the real economy, because that's what we should be here to serve. I will say in that context that most of the references to derivatives this morning so far have been to a market that I simply don't recognize. I don't think the crisis was actually about derivatives. Yes, it was about AIG, but that was an issue of poor regulation. The crisis was actually about the failure of risk management within banks. It was a lamentable discovery that banks did not know how to manage and price risk. It was a failure of bank compensation policies that led to motivation being focused on very short-term results that were not in the interests of the wider stakeholders. It was a failure of regulation. Where were the regulators when AIG was building up all those positions? And AIG was not a corporate, by the way. And of course, it was a failure of bank resolution, and that's the one that probably worries me most of all, because I think, as has become clear so far this morning, very few people in this room think that in Europe, or indeed elsewhere, we've really tackled the issue of being too big to fail. So I hope that as we go into this debate, we'll bear in mind that there's 5% of those derivatives that are outstanding that actually drive the real economy's ability to mitigate risk. And I hope also we'll have a pinch of salt when the politicians, the G20 resolution, or the academics, or the consultants tell us that this is how business ought to operate. The way business operates is the way the culture of good corporate management has developed over years, and it's really those are the people that should be being asked to explain to you why derivatives are important. Thank you.
Thank you, Richard. Our next speaker is probably known to almost everybody here, if not everybody here. Thierry is the Secretary General and the head of Finance Watch, which we're biased. We think is a terrific organization that not only produces high-quality, independent work and research, and has an incredibly talented staff that combines private sector and public sector experience, but also acts as a convener for discussions and bringing together different perspectives like this several times a year, and provides a great public service just in that. So, but in the slice of his life that involves actively trading derivatives and being a market participant for many years, and as somebody who is now on the financial reform side, looking at the much broader picture within which the actual operation, both in the real economy and the finance economy, if I can call it those two things, is a panelist here. So thanks for joining us, Thierry, and let's hear your thoughts.
Thank you, Dennis. Well, we have two big topics today within that derivatives discussion. One of the two topics I will really leave to the other panelists, because I think we have a brilliant set of speakers to address the issue of, is the derivatives regulation we have put in place a plus or a minus for the real economy? I think we all agree that finance should be not the objective but a mean. Okay, fine. So if we're regulating finance, this is with the view that it should promote the development, for lack of a more accurate description, of the real economy and of society. So is the regulation, derivatives regulation we have put in place, serving the real economy or not? I don't want to get into this because I think that between John, Jennifer, and Richard, we've got just the best set of speakers we could almost ever think of to discuss that issue. I'd like to elaborate a little bit more on the second topic, which is, do we need a $700 trillion market? There's many issues behind that topic, and it's a big regret. And I hear what you said, Richard, but I still regret that ISDA is not with us today because, at the end of the day, it's their responsibility to say that, they think, the market, to give us their view on what the right size of the market should be. So what I'll try to do, very modestly, is to reflect what their positions could be or is in what I've heard, and I've heard them quite a number of times say things in favor of that sort of size, and I will give you, surprise, surprise, my point of view on those arguments. And first of all, there's always a big debate. Is that $700 trillion meaningful or not? I've heard so many times that this is not the right measure. By the way, what are we talking about when we say 700 trillion? That's 15 zeros in case you had a doubt after the 7. That's 10 times the world GDP. So 15 zeros after that big 7. Okay, what are we talking about? That's the underlying notional amount of derivatives outstanding. What does that mean? That means the amount of financial assets actually controlled by those derivatives. Let's listen to the word derivatives. So it's derived from something else. It's derived from what? Well, from a financial asset. So we have, 10 times the world GDP of financial assets controlled by those instruments called derivatives. That's a fact. So is it the right measure or not? I think it is fair, and there's a number of industry representatives in the room. I'll be very happy to discuss with them. It is fair to say that very often it is said that, the head of investment banking of a major SIFI was telling me the other day that this is the wrong measure. It's not the right way to look at it because it doesn't measure risk. This is true. That $700 trillion figure does not measure the risk we have. Thank God. We're talking 10 times world GDP. You lose 10 basis points of that, and there's not one bank still alive in this world. So I hope it's not measure of risk, and I know it's not measure of risk. So this is not what we're talking about. The derivatives industry often say that the right measure should be the gross market value of derivatives. The gross market value of derivatives is just a measure, it's the sum of the absolute value of all the derivatives outstanding in the world. By the way, we have to bear in mind that roughly 80% of derivatives outstanding are swaps. A swap is, I'll pay you something, you pay me something. When you price a swap, the value of a swap when you deal it is, by construction, 0. So if you think the market value, and there's a debate, gross, net, etc., is the right measure, means that 80% of that derivatives market is meaningless. I don't know why I have doubt. It's not a very good start. To give you an idea, the gross market value of derivatives market at this point in time, or last time at the end of last year, should I say, was let me get it right, $23 trillion. So that's 3.6% of the outstanding notional. And if we take the net measure, and we heard Adrian Blundell-Vignal tell us this morning that it was not the right measure because it was a settlement measure, not a risk measure, then we go to 3.6, which is about 0.5% of notional. So what's the right amount? And many people say that the size of derivatives market has decreased since the financial crisis because the gross market value has declined. Sorry, this is not technically correct. If the gross market value declines, it just means that the volatility in the market has gone down, so the derivatives are worth less in mark-to-market measure. It doesn't mean that the size has decreased. We have the official Bank of International Settlement numbers here, and I can bore you with each number, one after each, if you wish. But all numbers show that it is still growing. We have a market which is, as Jennifer was saying, 10 times the size that we had in 1998. Okay, and then I'll link that to the question, or to the point that Richard was making, 5%, I had 7-8% in mind, doesn't matter. We're talking orders of magnitude. Between 5 and 8% of all the derivatives outstanding are actually dealt between banks and non-financial corporations. Okay. This is a very interesting number. We have to reflect upon that. If we link that to, and obviously, the argument we hear all the time is we need derivatives for hedging. Yes, no doubt. Derivatives are an excellent hedging tool. In my view, I was in that industry for almost 20 years. So there's just no doubt that it's a very good hedging tool. So let's not discuss that. What do we think of a market where between 5 and 8% is actually used for hedging? What's the rest used for? I know all the arguments, you need to rebalance your book constantly, to do that, but let's ask ourselves another question. Let's go back to 1998. For many of us, that was yesterday, okay? Sorry for the younger generation. Were companies not able to hedge their risk, FX risk, interest rate risk, or commodity risk in 1998? The answer is there was I was a derivatives trader at the time. I assure you that there was a very lively market for providing hedging services to companies in 1998. So we have a market that has been multiplied 10 times in size over the course of 12, 13 years, 15 years. Okay? When the world economy has grown 100%, 120%, EU economy has probably grown 40% in the meantime, okay? The size of the underlying financial assets has grown only a fraction of that. And that's very interesting to also ask ourselves because, sorry to go back again to the same principle, derivatives are derived. Okay. Size of bond markets in the same time, I have the number here, have grown 140%. So derivatives grow 540% when bond markets grow 140%, and equity markets, very poor performance in the meantime, have grown 35%. So you have financial assets growing 35 for equity, 140 for bonds, and derivatives growing, 540. Is that still hedging? Is that, serving a real purpose, or is it something else? We'll hear Kelleher this afternoon. At the end of her book, some of you may have read it, Bull by the Horn, she says that there should be a regulation for the specific case of credit default swaps that would link the fact that you hold a credit default swap to an insurable economic substance. Okay, if you're hedging, which is effectively what we did in Europe by passing legislation to do that, with so many loopholes that it has no actual effect, but so-called level 1 legislation was good on that, even though because of very hard lobbying at level 2, the actual implementation is not happening. Let's call a spade, but at least legislators did their work. But there should be a link between the use of derivatives and the use on the underlying. That is a very intimate conviction. Now, the last question is, why? Actually, there's two last questions, and I'll try to be brief. There's the why, and what's the consequence? Why are we facing a situation where we have a market that is growing so much? The answer to that is very simple. This is, and this goes back to our previous panel, this is the too big to fail subsidy that is feeding that market. Derivatives market is an oligopoly of SIFIs. You have all the 14, 15 largest banks in the world that control 80, 85% of the derivatives market. And surprise, surprise, they are the ones who benefit from that public support, and they can refinance their derivatives book, at a cost that is artificially low, and that artificially feeds the growth of that market in a situation where it would not grow if you didn't have that subsidy. I sat in one of the biggest derivatives dealing rooms for many, many years. The treasurer was sitting next to me, the treasurer of that room, as Richard is sitting next to me for years and years. The guy would borrow each day 40, 50 billion euros at LIBOR flat, Euribor flat. Question is, what should have been the right cost of borrowing of that particular gentleman, who's a brilliant guy, by the way? The answer is, without too big to fail, syndrome, it would have been 2, 3, 4% higher than the actual cost of borrowing we enjoyed at the time. And where it becomes really interesting is that the profits derived from that particular dealing rooms were, surprise, surprise, between 2 and 3% of the amount borrowed each day. So what I'm saying here is that the growth of the derivatives market, I'm not talking about the usefulness, I'm talking about exponential growth that doesn't seem to be limited, is fed by the too big to fail syndrome. And this is why we at Finance Watch link this particular issue to the issue of reforming the structure of banks, because if we don't tackle that issue, I'll bet you that we have the same conference 10 years' time, derivatives market will be 30 times world GDP, percentage of transactions done between bankers will be 99.5%. And where do we stand? So why is it important? You think, after all, making money is good. It's perfectly legal. It makes money. It makes profits. Those guys, pay taxes, creates employment. So we should love it. Well, the biggest problem is that it is the major source of interconnectedness between banks. And interconnectedness creates the fragility that we see in the banking sector. And until we have resolved that fragility, we will have, and that's the bigger issue of certainly here in the EU banking union, but more generally of having a stable banking structure and system, it's the issue of we want this whole thing to be stable. So until we have tackled that issue, let's not fool ourselves. We will not have a stable system. If I may, if you give me, stop me if I'm too long, Dennis.
1 minute.
I will, in all due respect, it's not a challenge, but relaunch something that Jennifer said. Jennifer said, and technically this is correct, but we have, I think, to go a bit deeper in what you said, Jennifer. We said, clearly the global economy relies more and more on derivatives. Is it the real economy? Or is it a game that precisely doesn't serve the real economy for the various reasons I just gave? I'm launching the question.
Thank you. It's a small, mere $700 trillion topic that has no complexity, as you can see. So we could cover these issues in probably 6 or 7 hours, so get comfortable. Two very provocative things, John, I thought maybe you and Jennifer could comment on. One is, I think some people would be surprised, if not aghast, to think that merely 5 to 7% of the derivatives market involves real end users, often understood to be the real economy. Now, recognizing that, let's assume for a minute that real end users just have one side of the trade, and therefore you need at least 100% of non-end users covering the other side, and assume for a minute that they can't all do it, right? So it's not merely 7% or whatever number we want to pick of the market that's end users and service end users, but it's certainly no more than, I'll make it up, 20%. So it raises a real fundamental question, which is if the market exists for the purpose of servicing the real economy, how can it be that only, according to my rudimentary calculation, 20% of the market actually services the real economy? That's the first thought I'd like to get your comments on. And the second part is, what do you attribute the apparently exponential, unlimited growth of the market, and whether or not there will maybe ultimately be a convergence where the real economy is going like this, and although it's at 20%, it will ultimately be at 50%, maybe. That's what the industry often says. So I'd like to get your thoughts on those two things. And then Jennifer, it seems to me those two issues, and whatever John says, has a lot of implication for how a regulator tailors regulations not just for yesterday and today, but tomorrow. So with those incredibly small questions, you have 15 seconds. No, kidding. John?
So I think this distinction between the real economy and the non-real economy is a meaningful one, but you have to be very careful with it. It's misused all the time. It's misused partially because there's all this finger pointing. We didn't cause the crisis, they caused the crisis. Don't regulate us, regulate them. It's misused because some people try to hide under the label of being non-financial. In the United States, in all of the lobbying over the Dodd-Frank regulations, you had this group of companies labeling themselves by various ways. The end users of derivatives. There was one, the commercial group of, I can't remember, some energy group that we were the real energy producers, lobbying for loopholes in the law, basically, and trying to hold on to the banner of we're real. But they housed companies that were doing derivatives dealing. They housed and have now had to register as derivatives dealers because, in fact, they were. But the popular awareness of it was not there. I agree with Richard. These derivatives markets can be great. I think I said that in my opening comments. But they can also be misused. And they can be misused by non-financials as by financials. Maybe you didn't have such a problem in Europe, but in the United States, we remember a company called Enron, which was a non-financial company, but part of the loopholes we had in our laws for derivatives, one of them is known as the Enron loophole, specifically crafted to allow a misuse of derivatives by a non-financial company. So they can be misused, but let's get back to Dennis's question. A lot of financial companies can sensibly use derivatives. The interest rate swaps market, the largest derivatives market now, is a very useful tool for banks to balance the mismatch of maturities on their balance sheet and decrease the risk. Insurance companies use derivatives all the time. Mutual funds that want to manage the volatile inflows and outflows of cash into the mutual fund and have to invest in the S&P 500, for example. You don't want to go buy all of the stocks of the S&P 500 if the cash is going to flow out tomorrow and then you'd have to turn around and sell them. It's cheaper, transactions-wise, to buy an S&P 500 futures, and it's very easy to get out of that S&P 500 futures. So derivatives can be very, very useful for financial companies. And so we don't want to just exclusively say non-financials as if they've got only virtuous people, and financials as if that's all evil. What we want to focus on is the right way to regulate them so that they're managed safely by whomever. So what Thierry was talking about before, why has it blossomed so much? It's exactly right that the balance sheet of the banks is what customers are looking for. People in the industry spoke about this over the last 20 years. It's a competitive tool for a derivative dealer. It's your balance sheet that you're selling to your customers. But it's not really your balance sheet that you're selling to the customers. It's the sovereign's balance sheet, the taxpayers standing behind your balance sheet that you're selling to the customers. So before the reform, we basically allowed these large financial institutions to market a product which didn't price in the risk of the product. That's then going to reverberate throughout the economy. Lots of institutions are going to make use of it. It's primarily the financial institutions that make exaggerated use of it because all of this trading by hedge funds, for example, relies very much on being able to get a huge risk exposure in the market to the bets they want to take and have very little collateral, not so many of those poker chips that were described earlier in the first session, on the table in front of the bets that they're taking. And it's the system that we had pre-crisis that made it so easy for that kind of trading to dominate the derivatives market. So what we want to do is get rid of the kind of trading that's not paying attention to risk, that's not priced and managed properly, and let the trading, whether it's by non-financial companies or by financial companies, that's really managing risk and really priced correctly, be the marketplace that we are encouraging and that we have our supervisors spending so much of their time sort of managing.
And so how do we end up with regulations that encourage good risk management and correctly pricing of assets in the derivative space?
well, hopefully through EMIR. Now, maybe just to make a few remarks. I mean, I would generally concur with the previous speaker. I mean, under EMIR, we do look very carefully at non-financial corporations. As the previous speaker said, sometimes they manage or act in a way that financial companies may act. But we want to make sure that these non-financial corporations who are engaging in derivatives activities of a certain size do manage those risks properly and do take the necessary steps to make sure that they do so safely. Nevertheless, we do have a phased-in approach. We have different thresholds through the technical standards from EMIR to make sure that only the largest companies are caught in that respect. Moreover, and as I mentioned earlier, the work on margining that's going on, the working group on the international discussions on margining requirements, one of the things that they have been considering very carefully is to get the balance right between regulating these entities and having high margins and high collateral and so on, against the impact on liquidity that this would have, and therefore the impact on the wider economy. And it's getting this balance right that is still under discussion, and I'm sure will be under discussion a lot in the coming year as the regulators begin to consult on that publicly. The last point, so how do we regulate in the future? We have to be very vigilant, and the national supervisors and ESMA and global supervisors, we need to keep discussing global regulation on derivatives, and we need to be very careful that there aren't loopholes being created that gives financial companies, in particular, we call it the so-called shadow banking system. Now, I know that some people say that's pejorative and so on, but that's the term used internationally, so I'm going to call it that. So we need to monitor the shadow banking system, and in particular their use of derivatives transactions, to see if they are taking advantage of loopholes, to see if they're trying to get around things, the requirements we have, and so on. In particular, there are a couple of areas where we've already identified that, notably the use of special purpose vehicles to circumvent EMIR obligations, as well as the development of structured securities which embed derivatives within their structure. So these are areas that we're looking at, and we'll have to monitor very carefully to see that they're not exponentially growing markets and posing risks for the future.
Great. We're going to turn to audience questions in just a minute, so if you've got them, get them ready. Richard, before we do that, I'm kind of curious, coming at it from the point of view that you have, what have you heard that most troubles you, or what haven't you heard that we should be talking about from the perspective of, the corporations and the Treasurer's office?
Well, thank you for giving me the chance to respond. I would have to take exception with some of what Thierry said, because I think Thierry, with the greatest respect, is being slightly loose and fast, or fast and loose, with the data. The real issue, I think, and you were suggesting you had the answer to this, has the corporate use of derivatives actually grown anything like the percentage that the overall market has grown? And I'm not aware of any data. I'd be very interested to know if there is any hard data. But everything I hear suggests that corporates are simply using derivatives in the same way as they've always tried to use them. And therefore all that exponential growth that we've seen in the market is nothing to do with corporates. The question is why has that growth happened? Well, of course, clearly, we're talking about two entirely different markets. The reason for that 80%, if we take your figure, Dennis, is that capital has been underpriced, risk has been inadequately monitored within the banks, and so traders went to town and earned themselves handsome bonuses and went off to live in the Bahamas. But that's nothing to do with the real economy. Where it becomes a serious issue is if it actually means that regulation is introduced that is driven by what happens in the financial sector and does not take proper account of what it does to the real economy. And let me just make one quick point, because I first went into the Commission in August 2009 to talk to David Wright and Patrick Pearson about the very early thinking on EMIR. And we pointed out to them, with the support of some treasurers, that what they were asking the real economy to do was to give up managing credit risk and to take on managing liquidity risk. And this, we thought, was a huge error in the G20 loose statement, all derivatives should be put into clearing. Companies don't have access to central banks. They don't have unlimited liquidity. And therefore, forcing companies to exchange trade and collateralize their derivative transactions would have drained away a huge amount of funding out of the real economy. And that's why, you know, to my dying day, I will insist that the exemption under EMIR and the carve-out under Dodd-Frank are entirely right, because what you don't want to do is penalize the real economy by forcing it to take on a risk that it inherently cannot manage, which is the extent of the liquidity calls that will be made under collateralization arrangements. And that's why it was so vital to protect the real economy's ability to use derivatives in a non-speculative risk mitigation way.
Well, one would think that if the real economy somewhat overlaps with the end-user percentage of the derivatives market, there wouldn't be much of a burden given the multiple exceptions and provisions for end users, both under Title VII of Dodd-Frank and as contemplated in EMIR. I think the bigger problem may be, as John alluded to earlier, the number of non-end users that have put on the end-user mask and have run around. I mean, when I was in the Senate, there was nobody who came in and said, I'm a financial player and I need an exception. Every single one of them said, I'm an end user. And in fact, John was referring to the End-User Derivatives Coalition, which was actually put together and sponsored by the biggest Wall Street banks. But they knew if they went in and asked for all the exceptions, they wouldn't get the hearing they wanted in the reception. So they came in as end users. So I do think it's interesting whether they're real end users or faux end users. The end user piece of the market has dominated the regulatory discussion, not necessarily in a good way or even to the benefit of real end users. But if they're at 5%, they should come out ultimately at the end of the day okay. Thierry, I'm curious.
Sorry, can I just jump in? Because I think that's a very unreasonable allegation to make that the end user coalition in the States is funded by Wall Street. It is simply not true.
Well, there's different ones.
It's funded by the corporates that were concerned about the impact of Dodd-Frank. What I will say, and it's important to say this, is that I think Dodd-Frank and EMIR have actually got it right, because what they're doing, they're capturing the likes of Enron, they're capturing the energy companies with trading wings. That's not what I'm here to defend. I'm not interested in defending trading rooms within corporates. I'm interested in defending the real economy's plain vanilla use of derivatives to mitigate risk.
Right, and let me be clear, there's a whole variety of coalitions in the U.S., and there are some legitimate ones, but there's also been significant reporting on coalitions that have called themselves end users that are not end users. And I'm not identifying actually any one in particular, but that's one of the problems that happened. It's pretty widely reported on. Thierry, you mentioned the trading of derivatives and CDS unconnected to any economic risk. And one of the things that happened during Dodd-Frank in the U.S. was an attempt to require, for example, CDS to only be allowed if, in fact, it was associated with an insurable risk. And that got almost no support, which is pretty interesting in a statement, I think, as to the state of affairs at the time. But if you could pick two things that you could write into EMIR yourself, what would those two things be and why in 1 minute?
1 minute.
Not to put our host on the spot.
No pressure. I mean, this particular topic is very interesting, and this, in a way, sorry, I might touch more than 1 minute, relates to the last discussion we'll have today about democratizing reform process. Let me tell you why. Here in Europe, we had EMIR say CDS must be linked to an insurable risk. So legislature did their work. You know, job done. Okay, Commission proposed, was adopted, Council, Parliament, you know, whole process went through, was adopted. Many people said, you know, big success, makes sense. Okay. And then, of course, there's the implementation of it. And you say, okay, what's an insurable risk? And then you get into the definition. And of course, it gets pretty technical. So you say, can I fairly ask the legislator to tackle that issue because it's so complicated? So it goes to level 2. And then the huge democratizing reform process lobbying machine starts negotiating about what's the correlation that you need to have between the insurable asset and the effective and the derivative itself. And in the end, I think the correlation that was decided after negotiating and everything was 70%. Well, anybody who's been in financial markets know that, for one thing, correlation is the most unstable thing on Earth, and B, that you can find a 70% correlation between the grades my little cousin is getting in math and the next crop of potatoes in Brazil. And I'm sure there's probably 80% correlation between the two series. So what I'm saying here is that we ended up with something that emptied, and this is about democracy, that emptied the initial democratic process that puts, that writes a law. And that's a big topic. I'm far from having all the solutions, because it is true that when it gets technical, you cannot expect from legislators that they would get into that level of detail. So I'll leave that debate for this afternoon. But this, to all of us who, here again, I'm convinced, are convinced that we need to build something that makes sense, is absolutely key. So it was not precise. Maybe very quickly, in response to what Richard said, we may have disagreements, but every single number I gave is an official Bank of International Settlement number. So I'm not being loose with my data. You cannot get more official than Bank of International Settlement, I think. And effectively, we're saying the same thing. You're saying, 5% real economy, etc. And the question is all the rest. Maybe last but not least, I think I deserve to tease you on two things. It's a bit of a stretch to say that no corporate ever speculates using derivatives. And I was a derivatives corporate salesperson for many years, so I could give you many anecdotes on the way we were making our money with corporates. But I'm not starting this because Finance Watch is not into naming and shaming. But there's many examples. More seriously, when you see the exemptions that were, implemented in EMIR on non-financial hedging, exemptions for clearing, we know what happened, here in Brussels on trying to get exemptions for that, in particular from airline companies, energy companies. And, it's very, very difficult to argue that, the oil producers, the commodity producers, the airlines, do nothing but hedging. And I'm not the best expert on this, so you guys all are. But it seems to me that the US has been stricter than the EU in that respect, and that it makes more sense because it asks for central clearing. And I know, Richard, you're of the view that asking for central clearing for real economy hedging is a drain on the real economy. I also know that John has been writing about this, so maybe there's a little bit of discussion to have between John and Richard on this.
And I think we really have to move. I know Richard's chomping at the bit, but maybe you could work it into the answer to a question. But I do want to get a couple of audience questions. We started the panel late, so we're going to go for a few minutes longer to take some questions. So raise your hands high because you can't actually see it all. The gentleman in the front, right over here. And please state your name and affiliation.
I'm Harold Schumann. I'm a reporter with the Berlin-based daily Tagesspiegel. Two questions. The first one is, it has often been reported that a huge part of the derivative business is dominated by very few players. I remember a Bundesbank report even calling it a cartel. My question is, do the regulation reforms we see and which have been announced and are now implemented, do they in any way address this cartel problem in the market? And the second question refers to what Thierry mentioned. This enormous expansion of the market for derivatives of all kind, is it really only attributed to the financial actors, or isn't it true that a lot of the financial departments of so-called real economy corporations are doing, in a certain way, banking business and the derivatives, the business as we know it from Goldman Sachs, Morgan Stanley and Deutsche Bank, maybe in a smaller dimension, but is at least one reason for this enormous expansion that the so-called real economy has becoming more and more financialized.
Thank you. First to Jennifer on the cartel and whether or not the regulations address the cartel aspect of the question. I'm not validating the cartelness of the industry?
Well, I mean, we at the European Commission, we have it's called a Directorate General, you're probably fully aware of it, called DG Competition, which follows these markets very closely. And you may have seen recently that there was a case on CDSs and that looked into the possibility of collusion and between the main broker-dealers and so on. So this is an area that we follow very closely. If there is evidence of collusion or cartels or so on, then it is for the Commission to look into and to research that on a base of concrete evidence. I think to any more would be speculation on my part, I'm afraid.
Thank you. And John, I'd like to start with you and then go to Richard. And the question on the growth of the financial market, whether it's financial actors or departments of real economy companies doing business, and I think you alluded to Enron, but I know a bunch of your writing has been on Shell and oil companies and other companies like that. Do you have thoughts on that?
Sure. So certainly there are so-called real economy companies that do a lot of what you call banking business, so run what I would call a derivatives dealership in-house. So Shell offers derivatives as a service to other parties. BP does the same. Many of the companies run speculative trading operations. Cargill, a big agricultural company based in the US, offers derivative services to various outside companies. I wouldn't exaggerate the significance of these things. They're relatively small in the grand scheme of things. They're not the reason that it's grown to the scale Thierry was describing. And I don't think we should put horns on anybody. I also don't believe we should put halos on anybody. You know, we have lots of real economy companies that operate captive financial institutions. That's not necessarily a bad thing. We have car manufacturers that sell insurance associated, and that's not necessarily a bad thing. And it's not necessarily bad that an agricultural company would offer derivatives as a service to various customers. What's important, even though they haven't yet grown very big, is that we come up with a regulatory framework that treats all companies the same. The issue is, are you dealing with derivatives? The issue is, are you managing that safely? As long as we provide regulations that treat all businesses the same, we shouldn't mind that a derivative dealership happens to get housed inside a company that otherwise is doing non-financial business. But if we don't treat them all the same, then while today we might be paying attention to where the real problem is in big financial companies, tomorrow, after we finish dealing with that, a lot of the business might go somewhere else.
Richard, where the horns and halos belong?
I mean, with respect, it really is very silly to suggest that the trading activities of Shell, Cargill, E.ON and so on are activities that the real economy practices. These are trading rooms. They choose, because it's in their business to produce energy or whatever, they choose to have trading rooms as part of their business. Those trading rooms don't benefit from the exemption. Quite rightly so, they don't benefit. So they're treated as NFC plus in European terminology. So they have to clear and do all the things that financial institutions have to do. In the US, the best of my knowledge, they don't get exempt either under Dodd-Frank. So the regulation on both sides of the argument rightly treats them as if they were financial institutions. So it's really a bit of a calumny to suggest to the audience that what Shell and Cargill do, there's a read across to the real economy. It's irrelevant. Now, the answer to the gentleman's question, which is an interesting one, of course, is very simple. There's a thing called IFRS. Now, if you sit on the board of a company and you're required, as you are under IFRS, to produce mark-to-market valuations unless you're able to hedge account, I can assure you your life in a corporate will be extremely short if you're trading speculatively in derivatives. No company with any sense is going to do that, and no company is. I spent 20 years in blue chip companies, another 10 years advising blue chip companies, and it is simply not the case that there is a speculative activity. You may have seen some of that, Thierry, from your options desk or futures desk, whatever it was, but that's not the real economy. You probably, I would suggest, were seeing the energy companies and some of the other entities that now, quite rightly, have been put into the basket that we call effectively financial institutions. But the companies that I worked for and the companies that I've advised would never do what you're suggesting is going on in the real economy.
All right, another question, and actually just one question that's concisely stated, so we can maybe get a couple in. There's a gentleman right on the corner of a seat there. Okay, well, you can both, one after the other, but one, who you are, your affiliation, and a concise question.
Yeah, hello, Fabian Lindner from the Hans Böckler Foundation, which is a foundation close to the German trade unions. I have the following questions, because banks obviously have an interest in supplying derivatives, but I'm really asking about who's demanding them, and we know that only, if banks themselves are demanding them, who really bears the cost at the end of the day? Because all the earnings that go to the banking system, somebody has to bear the cost. Who is the one who bears the cost? The second short question is, isn't it that we also have an explosion of derivatives because everybody thinks, okay, once I'm covered, once I'm hedged, I don't have any risk, so everybody thinks we don't have any risk. And the other question is it some regulatory, is it in the risk weighting, can you decrease your risk weighting in assets if you're covered by financial derivatives?
Thank you. Thierry, do you want to take that?
You're asking, is this working? Yeah. Effectively, one of the questions you're asking behind what you said is, can you hedge everything? Is it possible to hedge everything? And I think the answer to that is that, yes, there's some micro hedging which is possible, necessary, indispensable. This is precisely what Richard is talking about, real companies hedging a real risk. But there's also, I would say, an illusion of macro hedging. You cannot hedge economic risk in general. And all that game has, to a large extent, thrived on the illusion of we're going to hedge everything so there is no risk in the system. But at the end of the day, this is a game of passing the hot potato, because you give me the risk, I give it to someone else, and we create interconnectedness, and everybody has risk. So there's a big difference between trying to do that and hedging a local risk, which makes sense for the real economy.
And let me go to another question. There was another gentleman. Could you stand up, name, affiliation, in a concise single question?
Sure. Stéphane Voisin.
Sorry?
Stéphane Voisin. I'm a
cost. Well, the cost. Well, first of all, there's not always a cost. It can be a profit or a loss. Okay, you have to. Let's look at the numbers. You have to recognize that on average, the derivatives industry has been incredibly good at making money, because it's 700 trillion. It's probably they're making 10 basis points on that, which is 70 billion worldwide. By the way, they could be losing that, but so far they've been globally making money. So there's not been a cost. There's been an indirect, implicit cost because of the subsidy that is extracted from society. And going back to the argument, and you asked the question of, have we done what it takes to address the cartel issue? And in my view, the answer is no. And doing what it takes to address the cartel issue, which is not addressing the issue of do we need derivatives, we do need derivatives once again, but addressing the cartel issue is reforming banking structure. And that's the other topic. Until we have reformed banking structure, we will not have addressed the cartel issue in derivatives. So this is beyond the scope of our friend Jennifer. This is not in the scope of EMIR. This is in the scope of, do we want to keep banks as they are and have that safety net providing funding subsidy that makes this whole business develop again and again and always more? And that's the issue, and we have to address it.
So,
gentlemen?
Yeah, Stéphane Voisin. I'm a sustainability research analyst. I started my career as a derivative trader, actually 30 years ago. Thank you for the very interesting roundtable. You address very well the issue of size, but I think beyond the issue of size, the issue of complexity, which hasn't been addressed. Part of the market is a simple market, and if all of the derivative market was CBOE, CBOT, and listed equity or bonds or soft commodity trading, will be fine. It's far from that. Lots of derivative markets, OTC, very complex hybrid products that most of us, and even in the banks, we do not understand. How do we cope with that? We know that we cannot pass this type of market into the listed market because they are too complex. So how we cope with that? And I think also, and my question is, the reason for the size of the market is also very simple, is the way traders have been remunerating over the last years. The reason for the size, the reason why the market is so large, is that a number of traders have been receiving very high bonuses for expanding this market. And I think this point hasn't been addressed. Obviously, CDF4, I mean, the regulation is trying to cope with that. As a trader, I don't think that if you get a bonus which is paid immediately on the theoretical value of your trade, even if it's a deferred bonus for 3 years, it basically copes with a problem where you basically trade 5 years, 10 years, or 15 years options. Basically, you have a risk until maturity, and as long as there is a gap between the maturity of the option you trade and your bonus, the way your bonus is settled, you will have a massive problem to solve. So,
on the issue of size and complexity, John, you've written a little bit about what I would call created complexity in dark markets that are opaque without transparency or price discovery, and therefore essentially a fundamental breakdown in what is supposed to be a market, which is now trying to change under regulation. How do you see the issue of complexity and size?
Yeah, if I was a derivatives dealer, I'd be thrilled to hear your question, because I've successfully got you bamboozled. You think these things are so complex, we got to keep doing it, that we can't possibly put them on exchanges. We can keep doing things the way they are. That's completely baloney. These things, the vast majority of derivatives that get traded could be easily moved over to listed exchanges and cleared. The complexities are very minor variations in details, which in the derivatives market, especially in the listed derivatives market, we already have a way to handle. We call those basis trades. You buy and sell the standard instruments, and then you buy and sell some other instruments that make some minor modifications to them. Much like you can buy your clothing off the rack and then take it to a tailor and have the hem adjusted a little bit, you don't need to buy custom-made clothes each time you go out to sell. So complexity is the tool that this cartel that was described, but also that the lobbyists want to use to maintain the markets as dark. These things can be made transparent, but it is going to be a fight. If I can be the American who suggests what I would like to have in EMIR, it would be a simple suggestion, which is hurry up. It's taking forever to make some of these changes, both in the US and in Europe. We now, in the US, have all of our derivatives reported to trade repositories, but nobody knows how to use that data. It's a mess of garbage of data in incompatible formats at lots of locations. One of the CFTC's commissioners has pointed out that you couldn't even find JP Morgan's London whale trades in the data that they're getting. So we really have to push that this reform gets implemented seriously and quickly, and that standardization, which is very possible, gets implemented.
Well, I think I'm getting the hook here on time. We're already about 15 minutes over. So please, for the panel.